It's Wednesday, August 1st, 2023, episode 9 of the Market Huddle Plus. I'm Patrick Ceresna. This week, I have the pleasure of welcoming to the show Nick Galarnyk from Optionfinity. We'll take a deep dive into options trading, asymmetry, risk management, and the psychological obstacles of short-term options trading. Quick disclaimer, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much market huddle may include flaccid futures, candlestick burns, and Elon eruptions. Okay, let's get Nick on the call. I have the great pleasure to welcome Nick Galarnyk to the show. Now, those of you that listen to that show that I cheat on Kevin with, Nick joins me at Macro Voices every single week to talk some charts. And we obviously talk about the markets, and you always express your option levels. And I just really wanted to get you onto a Market Huddle Plus session so we could just take a deeper dive into options trading. So thanks for joining me, Nick.
Thanks for having me, Patrick. Great to be here.
So listen, I wanted to first off just talk about how we met. It was a networking at a Market Huddle piss up. So we were doing the big piss up with like 100 Market Huddle listeners out in Toronto. And I was just chatting with Jamie, one of the coworkers of Kevin. And he said, listen, I've got this buddy named Nick that loves options. You got to meet him and talk to him. And I was like, for sure. And so we reached out and we started chatting. And since then, we've had a couple of our own little piss ups. One time we met up in Seville, Spain for a weekend bender, and then you brought a whole group of your buds for a bachelor event out into Lisbon. So it's been a pleasure knowing you as a friend and as a fellow options trader, and I'm glad to have you on the show, bud.
Absolutely, we had some great times in Seville and Lisbon. Thanks again.
So listen, bud, before we dive into the options, let's quickly just give everyone a rundown. How did you get into options trading and how did you, develop a career in this?
Well, I first started trading equities before I started trading options. And the reason why I got into that was because my grandma, who's still alive right today, she's almost 80 years old, God rest her soul, she was trading equities herself, not very well, because she had two friends down in Florida that were doctors and they were retired. And so they decided they wanted to try and make $100 each per day. That was their objective in retirement. So she was kind of trying to follow their path, but she didn't really have any training whatsoever. She's an accountant by trade. So I was working various jobs growing up, butcher, mowing lawns, like delivering papers, the typical stuff. And she asked me, she said, Nick, what are you doing with all the money you're saving? Because I've always been pretty good with my own money. So she said, well, you should take some of your money, and if you want, give it to me and I can invest it for you and it'll grow passively. I said, okay, well, how much do you think I should give you? She said, whatever you can afford to give. And at the time I had about $8,000 saved. And so I gave her $3,000 and she had put it into, I believe it was CIBC stock. And in a few months, it turned from 3,000 to 3,300 or so. So I asked her about it and she mentioned that it had grown 10% to my surprise. So she said, what do you want to do with it? I said, well, I want it back, right? So I got the money back from her and I went to the ATM and withdrew $300, the profit. And I thought to myself, like, I want to do this for a living. So,
you and everyone else, buddy.
Yeah. So that was a very young start. And, throughout high school, I did a course where we had a stock picking competition. I actually had a friend whose dad trades options for a living, and he still trades options to this day. His name's Brad. And so in our class, my friend Mitch and I, we decided to buy BlackBerry call options before BlackBerry obviously imploded. And so we won the competition because we bought these call options. No one else knew what we were doing. Everyone else bought equities. And I think we made like 120% or something like that in that one semester. And so we won. And again, that further reinforced my love of capital markets. And so I kept on reading different books, by Buffett, by Nassim Taleb, by Mandelbrot. And that kind of further spurred my love as well. Now for university, my parents pushed me into IT, which I didn't really enjoy too much. So after my first year, I switched from IT into finance, and I finished my degree in finance and statistics. And then from there, I ended up working at a hedge fund out of school. And then I ended up working in consulting for a bit. And then I ended up running a fund, a family office, before managing my own portfolio, which I've done for the past roughly 8 years now.
Oh, it's awesome. All right. Well, listen, that's a great story, but let's talk some trading. And, I absolutely love option strategies, and you have taken the next level with a lot of your more intraday setups. And the one thing we both share is, our love for seeking asymmetry in an opportunity. And so why don't you take a moment to kind of explain the way you approach asymmetry and probabilities and the way you look at trades?
Well, the primary way that I look at trades, when I analyze a given trade, the first thing I think about is, if I wouldn't buy this position, does it make sense to sell it? Which means if the probability of losing if I were to go long a position is low, then does it make sense to sell the position instead, because it would give me the reverse effect where it would be a high probability of a win if I were to sell it. So take iron condors, for example, where you're selling premium on both sides, a spread above and a spread below. For those that aren't familiar with iron condors, the way you construct one is you sell a call spread for a credit out of the money above the current spot price of an asset, and you sell a put spread the same width as a call spread out of the money, again, below the spot price of the current asset. So if we're looking at, for example, SPX, which is right now, spot price at close today was 45.76. For tomorrow's OPEX, which is August the 2nd, if I'm looking at the current option chain, I would say, okay, right now, based on the current probabilities, based on the delta, which is the theoretical probability of an option expiring in the money, I would look at, for tomorrow, perhaps the 46.10 short. And then if I were doing either the 46.20 long or the 46.30 long, depending again on how much credit I would get. And on the put side, I would do the same thing essentially. I would sell the 45.35 or so, and I would buy the 45.25, for example. So in this case, you pull in about $1 credit or so on $9 risk. And again, asking the question, would I buy these contracts? Would I buy the long position here, aka a bull call spread and also a bear put spread? And the answer is probably not, because the probability of winning this trade is very low. It's less than 10%. So that's my approach in all my trades that I take is, again, if I wouldn't buy it, would I sell it? And if I wouldn't sell it, should I buy it perhaps?
Right. So you have a very high probability of this expiring, but you are counting on that for creating your edge.
Absolutely, yeah. It's kind of like thinking about, the game of roulette, for example, right? The casino has an edge in roulette, and the casino has an edge of about, I think it's, so the probability of, if you bet black over red, for example, is 47.4% probability of winning. So the casino has a very, very slight edge that they're going to win if you take one of those bets. And the way they make their money is that over time, over the course of millions of spins of the wheel, they come out on top. So the same idea applies in these trades, where if you're taking consistent decisions and you're trading the same way, same position size, obviously, as well, because you need to manage your risk. And if you're trading sporadic position sizes, you're going to have sporadic results. Then what will happen is that on a long time horizon, the probabilities end up rolling in your favor versus against you.
Right. Well, the interesting part about the trade you're proposing is that you're taking advantage of those dailies, right? Like, this is an option that expires within 24 hours, and I would imagine you open it the same day, or you're opening it the day before.
Yeah, so zero DT options came about every day of the week. I think it was last May of 2022, and that afforded me the ability to do this every single day. Whereas I would prior just do it on Wednesdays and Fridays. So now they have them available, Monday through Friday. And so yes, I typically take the trade for a condor on the same day. So not the night before, because again, that presents a risk of overnight gap up or gap down. And if you look at the charts of the S&P, for example, over the last 20 some odd years, it's evident that overnight in the futures market, that's where most of the moves occur. During market hours, during the 9:30 to 4 p.m. Eastern time session, we see very, very nominal movement. I think we're up plus or minus 2% right now over the past 20 years during normal trading hours. Meanwhile, the majority of the gains have come, in the futures market, right?
Yeah, in the overnight markets and then creating the big gapping moves that happen that way. So yeah, a lot of the skeptics towards the days till expiration options is obviously the huge gamma that comes inherently associated with the risk, especially on the short side. But the interesting part is by constructing it as spreads the way you are, you have a very neutral type position where essentially you have a very defined risk, and certainly you don't have the ability. You have an ability that when that position starts going against you, you have one option position that is working in your favor while the other one is losing. And how do you approach this in terms of like identifying, when a market is more neutral or directional? Like, how do you go through the process of determining that this is the day that I'm putting this on, or do you just indiscriminately put it on every day?
So for data collection purposes, for my strategy, I do put at least one position on per day just to collect data, but I don't trade my full position size every single day. So part of the key is identifying what type of market that we're in on a given daily basis, right? Or for a given, time period. The period of April to May this year was very, very choppy, and this strategy worked phenomenally well. If we're in a trending market, for example, where we see a big gap up or a big gap down on the overnight session, typically I'm more cautious because, again, that might denote a trend down or a trend up, in which case the strategy would lose. So it's important to pick and choose which days you're taking a certain strategy, and also know enough strategies that you can actually, perhaps make money on any given day. So if we're in a trend market, for example, a straddle might make more sense where, again, you're directionally agnostic, but you're buying both a call and a put at the money, which is when you're buying, a call and a put at the spot price, essentially strike price. And typically, these straddles on SPX at open in the morning, they go for around $17 to $18. It depends on if there's an event or not. Like, for example, if there's economic data at 10 a.m. or if there's an FOMC event. In the case of FOMC, it makes no sense at all whatsoever to use this strategy because obviously the premium decay on these contracts does not set in until like 2:30 p.m. after Powell's already spoken for a bit. So it makes more sense to avoid certain days. Like I tend to avoid CPI, PPI days. Over the past few months of late, they haven't been that bad at all. They've actually been winning days. FOMC days as well. Although you can get a lot of premium far, far out of the money, it's still risky because all it takes is one wrong word by Powell or one weird question from one of these journalists, and the market sells off or pumps and causes you to stop out of your trade.
Yeah, so it's very important to highlight two things to our listeners that are maybe not familiar with these more advanced strategies. What Nick is actually trying to do is anticipate a kind of a box of where the market is going to stay within. And so if, let's say, in this case, it was a 30 or a 40 S&P point range, marking an area above it where the market isn't likely to go, and below where the market isn't likely to go, and simply taking advantage of the incredible time decay that happens in an incredibly short window of time on these options that expire the same day, right? And so it's all about capturing a range where you don't think the market will go, and then just sitting there and watching for several hours as you try to harvest a certain amount of income. Is that a good way I described it?
That's actually the perfect way to describe it because, again, a lot of it is kind of like watching your life slip away during market hours, but you're also profiting off of it. So instead of doing, betting on a directional move, like today, for example, the range on S&P was, on SPX was, I think it was 45.67 or so on the downside, and the upside was 45.84. So that's a very narrow range of about 17 points on an asset that's $4,500 plus. So most people that are betting directionally aren't going to win on a given day like today, for example. So the question that's begged is how do I profit on a day when we're just sitting in a choppy range? Well, there are strategies to benefit from that, right? You're just benefiting off the time decay.
Yeah, no, that's it. But it's very much, it keeps you glued to your machine, of course. Like that's the trade off. I mean, that it is even though it's an inactive day trading, it very much needs to be managed as though you're day trading, and along the way. So what is interesting is how low daily 1 day volatility has actually come in. I mean, when I look at the 1 day vol index on CBOE, we're talking about single digit vol levels. And it just really shows this kind of almost summer doldrums that we've had during this market crawl. Have you noticed that it's that you're having to go much tighter on your condors to get the type of returns that you typically have? How's this? How have you observed this in the way that you've been trading?
Yeah, so last year, 2022, was great for volatility because the market was falling the entire year. So the VIX was staying elevated for most of the year. And in that case, selling premium was phenomenal because you can go so far out of the money that the stop loss would almost never hit. So it was a very profitable strategy last year. This year, it's still a very profitable strategy, albeit it's much more of a battle because you're fighting these tighter ranges where, last year the ranges would be as high as 80 to 120 points. Nowadays we're looking at ranges over the past, few weeks. The average range on the S&P is 32 points. So that's a very, very narrow range relative to, 80 points, for example. And as a result, when the VIX is lower, market participants aren't betting on a large move in either direction on a given 0-day position. So when that happens, you're not going to see a lot of volatility where it's going to push, 50 points out of the money unless we get some kind of catalyst event.
So I'm just curious, I'm just poking around on your, obviously there's the vol skew that has that fat left tail. And when you're doing this type of an option strategy where you're writing these dailies, does that in any way ever, especially when we're in a bull market that is generally rising more often than it is dropping, does that ever have you break the wing on the put side and widen the spread on the puts to grab a little more there, or do you stay pretty disciplined on making it a clean condor for the risk sizing?
So because I trade for a living, I have to manage my risk very, very stringently. If I break any rules at all and take a big loss, it can cost me, a few months of work perhaps, right? So I'm pretty strict and very disciplined about my risk management. I don't tend to do different size wings on each side because, again, the margin impact is different as well. If you do, for example, a 20 wide on one side and a 10 wide on the opposing side, IBKR recognizes it as two separate trades, right? So not one overall condor. So though it might make sense in certain cases where there is skew on a given daily basis, to the put side perhaps, to sell a wider put spread versus a narrower call spread, I tend to do the same width on both sides, but it varies day to day. Some days I might do 10 wide. And some days I might go 20 wide. Again, it depends on how much credit I'm getting, and it depends on what makes sense. Because if you're going, an incremental $10 of risk for an additional, 10 cents of credit, it doesn't make much sense. Versus if you're incurring an additional $10 of risk to make an additional, let's say, 50 or 60 cents of credit, that makes more sense, perhaps.
All right, so let's move on from the S&P because I know that you watch some individual names in the markets as well, and you put on some different options trades on them. Obviously, we're in the heart of this earnings season. Is there anything that's been standing out for you? Any odd options activity? Is anything that grabbed you that you want to talk about?
Not so much this earnings season. I mean, what I find though is that every earnings season there's a common theme, and usually if you can pinpoint it by, let's say, the first week, typically you can play off that theme. So, for example, you might see that premiums are too low, in which case we're getting exaggerated moves on either side, and so you can price out the straddles, which are the at the money call and put combined, and figure out what the expected move is on a given asset for that week, right? So, last week, Meta, for example, they had they were at around 300 and the straddle price was, I believe it was $24 or $25. And so they actually hit their expected move. They pushed to as high as 326, but the day following the report, they'd fallen with the market, because Thursday we had a sell-off due to the BOJ news, and they fell from 326 all the way down to 309. So that was an interesting observation there, because we hit the expected move and then it pulled back down all the way to only plus 9 points from the previous closing price. But in general, I try to avoid earnings plays just because they're too binary. If I am going to trade an earnings, I have to have a very strong thesis. I mean, I have made some great plays on earnings in the past, in my younger years when I took, when I was a bit more cavalier perhaps and took a lot more risk. One trade comes to mind where I had traded GMCR, which is Green Mountain Coffee Roasters. They're no longer listed anymore because they were acquired. But I had a strong thesis as to them following an earning report. And so I bought these put options for 12 cents a piece. And the following day, they went $8 in the money. So I turned $1,200 into $80,000 in one day. And that was it was a gamble again, because the probability of that happening was so minute, which is why the options were priced so low. I would never, ever do that trade ever again, right? But that
Teenies for Lamborghinis, right?
Exactly, yeah. Yeah.
Listen, I want to talk a little bit about the psychology that comes in and the risk management needed with associated with day trading, because while most people know me for running big picture trading and trading on a much larger time horizon, I actually cut my teeth in some day trading, as I ran a SPOOS trading room for 3 years. So I was grinding charts and calling trades nonstop for a while. And so I lived in that same arena that you still do to this day. And everyone loves the glory of day trading, this idea that where you, just like your grandmother wanting to pull out $100 out of the market a day, the appeal is there for everybody. But what I have found over the years is that while it appeals to everyone, only a few people actually have the psychological disposition to be able to consistently do it day in and day out in the meat grinder almost to kind of deal with the psychology associated with it. So how do you manage your psychology? How do you approach the psychology involved in such active trading?
That's a great question, and a very important question for those that are day trading as well, because again, the majority of the battle is within your own head, right? Between your own two ears. And, I've experienced every emotion there is to experience in the market, essentially. And I've learned what I don't want to experience again. And I've learned what I do want to experience again. So, again, the volatility of your decisions denotes the volatility in your portfolio. So, one of the biggest things I find that exists nowadays is FOMO, right? A lot of people get FOMO by looking at other people posting their trades on names like StockTwits, for example. And so they say, okay, well, this person made $100,000 in one day. And meanwhile, I might be making $50K at my job, for example. And I want to do that too, because, I want to feel that same kind of pleasure of making, 2 years of salary in one day. So what happens is that you make these emotionally charged trades that are devoid of logic, which results in almost no thinking around probabilities or risk management, and typically leads to devastating losses where people blow up their portfolios and swear off the markets. That's one of the key issues, right? A second issue that I find a lot is revenge trading, right? So you take a loss perhaps on a good trade and a good setup, and you want to make that money back. So perhaps you set up to lose maximum of $1,000 on a given trade, and then that stop loss hits. You take your loss of the $1,000 and then you want to chase it back. So you take maybe a larger position size than you normally would to try and make that money back. And then you might lose again, right? So it creates this kind of perilous feedback loop where you just keep losing and losing and losing. And what happens is that you kind of forget about your rules, and you go in a state of despair where you just start chasing after these losses, and you hope to get back to break even before the day's done. Before you know it, you've taken far larger loss than you've ever would have imagined, for example, right? And then there's, of course, the third issue that I find, which is the gambler's fallacy, right? The belief that each trade is somehow, unrelated to the previous one, and related to the previous one, and that a string of losses will increase the probability that the next trade's going to be a winner. So you might lose, for example, a few trades that are risk managed and say, you know what, there's no chance I'm going to lose my 7th trade in a row. So you might go double your size, for example, right? It's the same deal with roulette where, each spin of the wheel does not correlate to the previous spin of the wheel, right? Or each coin flip, for example, does not correlate to a previous coin flip. So those are big, big issues that I find that are present with a lot of traders nowadays. And, you got to think about your primary objective, which is being consistently profitable. And, one thing I've learned in my readings and lessons over the years by trading is that in order to be consistently profitable, you have to develop a pattern of decision making, right? If you're not going to follow a pattern, how are you going to follow a pattern in your profits, for example, right? So there's a lot to unpack in that question, and there's a lot to think about. But like, you are your own worst enemy, and having, a proper discipline around trading is very important. I always say to those that want to get into it, if they're very eager to start very, very small, take $1,000 and put into an account and trade very, very small positions. Because again, the objective at the onset of learning how to trade isn't about making money. It's about learning how to make good decisions. And so if you're taking large sizes, you're trying to swing for the fence and trying to make profits. But the proper way to do it is to take small positions and see if you're correct, test out your ideas and validate them. And if you validate your ideas, that gives you the confidence to scale up over time. But again, the key is always managing your risk, right? I'm always, maybe I'm more so over managing my risk, a lot of the time, but that's because I trade for a living, right? So it's much more important to me that I'm consistent versus hitting home runs.
Well, listen, Nick, it was great to have you on the show. Before I let you go, though, why don't you tell our listeners a little bit about what you do and where people can follow and find you?
Yeah, so I do mentor individuals one-on-one, and you can find me at optionfinity.com. If you do want to get a hold of me, my email is nick@optionfinity.com. That's OPTIONFINITY.com. I don't have any social media at all. So I've always been very, very against, Facebook, Instagram, and Twitter. So I've never had these mediums of contact.
Nick, it was great to have you on the show. Hope to have you back soon. Thanks everyone for tuning into the Market Huddle Plus. We appreciate you spending the time with us. And listen, you can never have too many friends. Bull market or bear market, we're just happy to spend some time together in this crazy ride. We'll be back on August 11th for the next Market Huddle episode. Cheers, everyone.